$500, 000 in your dividend ETF should feel safe. It should feel diversified. But research shows 35 to 45% of most popular dividend funds sit in just 10 megacap stocks, usually technology and financial firms. When rates spike and those 10 holdings drop 15%, you lose $50, 000 to $100, 000 in principal, while your dividend distributions are taxed as ordinary income at up to 37% federal rates. That advertised 4 to 5% yield, it shrinks to 2, 5 to 3, 2% after taxes. For $500, 000 position, that's the difference between $20, 000 and $12, 500 in annual spendable income. And if you're forced to sell shares to cover your retirement cash needs, you crystallize those losses immediately. By the end of this video, you'll know exactly how to spot concentration risk in your own holdings and what the SEC data reveals about the dividend ETFs most retirees own. Let's start with the wrong belief. A dividend ETF marketed as diversified and market tracking holds truly diversified assets across sectors and company sizes. The prospectus says diversify. The fund name says diversify, so it must be right. Wrong. Research into SEC filings for funds like SCHD, VIM, and DGRO reveals that the top 10 holdings often represent 35 to 45% of total portfolio weight. For context, the S&P 500 itself deliberately limits any single holding to roughly 7%. When a dividend fund concentrates 40% in 10 names, it's not tracking the market, it's betting on a narrow slice of it. Add rising interest rates to that picture, and those mega-cap dividend payers, the ones everyone crowds into during low-rate environments, become vulnerable to sharp repricing. The 2022 Federal Reserve hiking cycle saw technology stocks fall 32% from peak to trough. Financials declined 19%. Both sectors are core dividend ETF holdings. A retiree with a $500, 000 SCHD or VYM position in 2021 faced a $75, 000 to $95, 000 principal loss over 18 months. That's not theoretical. That happened. Here's the tax math nobody discusses. Your dividend distributions are taxed as ordinary income, not capital gains, up to 37% federal, plus state and FICA taxes depending on income level. On $20, 000 in annual dividends from a $500K position, you owe roughly $7, 400 to $12, 500 in federal and state tax. Your net spendable income drops to $7, 500 to $12, 500. But if a rate shock forces a 15% sector correction and your $500K position falls to $425K, you've lost principal equal to 5 to 2 years of dividend income. To maintain your retirement cash flow, you must now sell shares at losses, crystallizing a tax loss but also reducing your base. Over a 20-year retirement, this concentration risk could cost $100, 000 to $200, 000 in foregone diversification upside and forced tax loss realization. Now the key question: how do you find your ETF's true concentration? The SEC requires funds to disclose top holdings quarterly. Pull your fund's fact sheet and find the top 10 holdings line. If the percentage shown exceeds 35%, you're holding a concentrated bet. Next, check the sector breakdown. If technology, financials, or utilities exceed 30% combined weight, your diversified dividend fund is actually a sector play. The IRS publication 550 confirms that dividend distributions from ETFs are taxed at ordinary income rates, unless they meet the holding period test for qualified dividends, and many don't due to the high turnover in actively managed dividend strategies. That invisible tax drag is the second reason your 5% yield becomes 8% net. The stakes are real. Ignoring concentration risk forces retirees to choose between cutting retirement spending, selling shares at losses, or holding through a drawdown and hoping recovery comes before cash reserves run out. None are ideal, but auditing your dividend ETF holdings today, before the next rate shock, gives you the chance to rebalance proactively instead of reactively. If you want the full numbers and the implementation checklist, the deep version is in my book Market Cycles Decoded, link in the description. The bottom line: a dividend ETF isn't set and forget if 40% of it sits in 10 stocks. Markets reward the patient and the prepared.